Budgets in the past have had a magical impact on stock markets. Remember the 1991 budget and then the 1997 dream budget? Lately, budget announcements are more incremental, but the cocktail of fiscal deficit plus tax changes plus capital expenditure can still bring out the bulls or scare them. So what are the key numbers or items to watch out for this year? First, the market, and more particularly India Inc., may not want to hear a very high fiscal deficit or market borrowing number. Our CNBC-TV18 poll says the average expectation is that fiscal deficit will be brought down to 5.8% from 6.4% in the current year FY23. This will mean the government will borrow a net, say, 11.5 trillion rupees from the market, plus a 5 to 5.2 trillion rupees borrowing by the state governments. The markets can stomach a 6.7 trillion borrowing number or thereabouts. Next, what are the GDP growth and tax assumptions? Nominal GDP. Here a CNBC-TV18 poll says a 10% nominal GDP growth and an 11% growth in taxes will be seen as fair. Remember, FY23's 15.5% nominal GDP growth and tax growth that was even higher can't be the base case for FY24. Next, the market may want to hear about capital expenditure. A 15% growth in capex to about rupees 8.7 trillion rupees is what the market is expecting. Last year, it was a big 25% growth in capex. Finally, the black box. Will there be any rationalization of capital gains tax on equities? Will short term be redefined, extended to 2 or 3 years? Will the tax rate on short-term capital gains for equities be increased? Those are the fears according to our poll. But let me defer to our experts. I have with me the best of market watchers, veterans, Hiren Ved of Alchemy Capital and Nilesh Shah of Kotak Mahindra AMC. Gentlemen, thank you very much for your patience and for attending to our pre-budget What Market Wants show. Hiren, first to you. And I have to ask you this troubling question first. If the short-term capital gains are going to be altered, extended term or percentage, will that be a big negative?
So Lata, Happy New Year to you, first of all. And yeah, I think what is most current in the minds of the investors is the noises around the potential changes in capital gains. Now, my view is that if they change the tenure of what constitutes short-term capital gains tax, I think that will be merrily stomached by the market, because by and large, people are long-term investors, and the difference between the short and the long-term rates is not very significant at this stage. What the markets may not like or investors may not like is there is a hike in the rate of taxes. And I think that is very important, not only from a domestic investor perspective, but I think it will also send a signal to the international investor community that you just changed the tax rates in 2018. And it would be important if you kept the tax regime fairly stable. So if we want to attract foreign capital, which we do want to, and we don't want to disturb the capital markets, then I think a rate change is something which is probably will be problematic. A tenure change will not be.
Okay, got that. Nilesh, similar question to you. In a previous occasion, you told us that a lot of gimmicks that are going on around capital gains, trying to disguise or dodge them, will be definitely, attended to. But this is a more direct question which affects everyone. Do you think that an extension of the tenure term of short-term capital gains or an increase in the amount will be received badly?
I think extension of tenure is logical. Today, there is 1 year for equity, 2 years for real estate, 3 years for debt. Any investor will say that 1 year equity is not long-term. So making it 3-year across the board will be fine. But we should not increase the tax rates. We should plug the loopholes around capital gains. Zero coupon listed debentures convert interest income into capital gains. 1 lakh crore is the outstanding amount. Assuming 10% interest rate and 25% tax arbitrage, that's collection of 2,500 crore. SME exchange IPOs are clearly, capital gains tax planning. Again, it's converting black income into long-term capital gains. If we plug that, that will result into further savings. Today, STT on cash delivery and FNO is the same. Some tinkering there, which will discourage speculative activity in FNO, again will result into higher income and will be good for the market. ULIP inter-scheme transfers are not taxed. 6 lakh crore AUM, assuming 30% switches, 1,80,000 crore. Assuming 20% tax arbitrage, that's again 3,600 crore for to be taken. So let's plug the loopholes on market-linked zero coupon listed debentures, ULIP interchanges, SME exchange, capital gains tax planning, and such kind of things. Then there will be no need to raise capital gains tax rates.
Okay. You're not just a good investor, you're also a very good tax expert, I must say, Nilesh. Hiren,
The blood of chartered accountants is still there in the system.
Yeah, absolutely, I agree. Hiren, we do worry a lot about the extent of taxes. Like both of you point out, if this 15% becomes 20 or 25, it'll be taken badly. When long-term capital gains tax was first introduced in equities, before that, the market, was very worried. But we took it in our stride and the market did very well thereafter. So even if there is some negativity on the rate, do you think it'll be a passing blip? After all, it's the growth story that will matter, no?
No, Lata, I understand because the markets are a mechanism which have the ability to discount both good and bad news, right? So I don't think it is about the fact that, we will keep brooding over it for a long period of time. I think, yes, whatever reaction has to happen will happen, and then people will move on, right? But I think what I meant to say was that, what is the need? I mean, we need a certain stable tax regime. We've just done a change in 2018. It was not too far back.
Yes.
And I think it's more a signaling rather than the actual increase or decrease in rates, which is important.
Fair point. Yep. No, actually, we've not heard too many big numbers even on that long-term capital gain. So probably it was not such a big income earner. And therefore, perhaps tinkering is not called for. But I'll move to the next other big number. What's the next big number you'll watch out for? Is deficit very key, Hiren?
Yeah, I mean, I think the deficit number is important, but everybody understands that there will be a glide path to fiscal consolidation. I think during COVID, it was okay to run large fiscal deficits. But now, I think if we want macroeconomic stability, and if we want the currency to be stable and interest rates to be stable, then we have to have the ability to show that we are on the glide path of reducing fiscal deficits, because deficits are never, it's good for a year, but the hangover is very, very bad.
Yes.
And I think what you have put out in your expectations is pretty much where everybody is in terms of the fiscal deficit. I think what was most credible was that, during the COVID years, we decided to bring all the off-balance sheet items onto the balance sheet.
Yes.
So that number became very credible. There were no whispers and murmurs about how much is shoved under the carpet. And I think there is a certain credibility that has been brought to the fiscal deficit management. And I think that should continue. And whether it reduces by a couple of basis points more or less, but I think the glide path is very clear. It's somewhere in the range where you have indicated.
Okay. Just to finish that point, Nilesh, would you say a GDP and a tax assumption between 10 and 11% for tax growth is something the market would watch very closely? I mean, this government has not shown a penchant for outlandish assumptions. But, we did do, I think FY23 is going to end with some big 18% rise in taxes. So do you think a high tax assumption will disturb the market?
So markets will be first looking at where the spending is occurring.
Okay.
Even if the fiscal deficit is higher than 5.8%, but it is for infrastructure investment, then it can be tolerated. Even if fiscal deficit is higher than 5.8%, but along with infrastructure allocation, there is a guide path to the lower path of the fiscal deficit, then again it can be tolerated. Similarly, on the taxation side, if you're plugging the loopholes, and there are so many which we can talk about, then higher tax collection can be assumed.
Yeah.
But if you're not going to plug the loopholes, then it's better to be conservative than aggressive.
Okay.
In fact, the
Fair
best
enough.
thing to do is, like ethical hacking, let's create ethical tax loophole plugging competition. There are many chartered accountants who will be more than happy to contribute towards improvement of income tax laws. They know where the hacking is possible. They'll give you solutions how to bridge it. And voila, the tax to GDP ratio will improve, will move from African nations to Asian nations in terms of tax compliance.
Excellent. Nilesh, you're much more than just a tax and a market expert. This is a genuinely great strategist. Yes, let's have a tax hackathon race. But you correctly started by saying, where is the money going to be spent? I'll do one thing. I'll take a very quick break and let's concentrate on the expenditure side and what the market wants. Back in a minute. Welcome back to our pre-budget special, What the Market Wants. I've been speaking with two market veterans, Nilesh Shah of Kotak Mahindra AMC and Hiren Ved of Alchemy Capital Management. Hiren, Nilesh, thank you very much for your patience. Before we went to the break, we did discuss taxes and income assumptions of the government. Now let us discuss expenditure, as Nilesh prompted. Nilesh, what is the capital expenditure number that you will watch out for? Will the market watch for it very closely? Last year, that is not last year really, FY23, this year it was a grand 25%. What's a credible number for FY24?
My feeling is that this is pre-election budget where generally government enhances allocation. Even though the last year's base was higher, could we target another 15 to 20% increase in allocation? And more importantly, let's focus on the execution speed. Prime Minister inaugurated Mumbai metros, but we all know at what speed Mumbai metro is being constructed. I stay in Andheri West, where East-West flyover is down since 2018. And we are spending more on fuel than what is the cost of repairing that bridge. So it's not only allocation, but also the execution, which is critical.
My sympathies for those of you who stay in Andheri. I have the monorail, so I don't complain. But, coming to CapEx, Hiren, the CapEx number itself, 15% would come to about 8.8 trillion. You think that's a very closely watched number? And I'll tell you why. Because there are some industrialists who say that CapEx cycle is still not picked up. It is about to pick up, maybe in a quarter or so. And therefore, the government should show its hand and continue to chug along with CapEx. So if it falls short of 15% or 20% that Nilesh is speaking about, will that be taken badly?
Yeah, I mean, I think in that sense, I concur with Nilesh that it's a pre-election year. We are still seeing the early signs of private capex. And whether private capex is starting or not starting, I think it is very, very important that we continue to spend on infrastructure, because that investment has a big multiplier effect, right? So I think anywhere between 15 to 20% is a good number to run with. And my sense is that it will be a significantly strong number in this budget as well. Because, you can't lose momentum on building capex in this country. See, we took some very wise calls during COVID. Instead of spending money on demand creation, we largely tackled supply and spending on infrastructure.
Yes.
Had we not done that, we would have had an even deeper problem with inflation.
Yes.
And I think we should continue to spend on the supply side, on infrastructure. And I think other than infrastructure, more incentivization for private capex would also be welcome, right? So just like what they've done with the PLI schemes,
Fair enough.
you need to spend 50,000 crores to spur a 5 lakh crore capex, right? So the impact is much higher. So I think 15% is par for the course. 20% would be great.
Okay. And if it is buttressed with, as you say, some more incentives for PLI or, more sectors in PLI, I mean, I can see that both of you will be nodding in agreement with such schemes. But Nilesh, repeatedly, both of you are using the word pre-budget, pre-election budget. I didn't think of this as a pre-election budget because there is a vote on account that will still be presented in February of 2024. So do you think a typical pre-election budget will be tolerated? One with, a large amount of social sector spending, extension of subsidies. Do you think these will be tolerated?
So I think the finance minister should learn the art of communication from US Fed of walking left and talking right. You have to do what is right for the economy from a numbers point of view, which is extra allocation to infrastructure and cutting down on wasteful expenditure, including subsidies. But in the budget speech, you can talk about, subsidies and poor and farmer and everyone else. There could be launch of newer schemes also in the budget for that thing. And clearly we are suffering today at a subdued consumption in bottom of the pyramid. So if some money is allocated towards supporting consumption at the bottom of the pyramid, market will be happy to tolerate. One more idea which finance minister should consider is to reduce the cost of borrowing for marginal and poor. They don't have access to organized financing and they do borrow at a very, very high rate of interest from unorganized market. Like we created MSME credit guarantee scheme during COVID time. If there could be a credit guarantee scheme spread over large number of marginal borrowers, which can reduce their borrowing costs substantially, I think consumption will get supported. The bill for providing that credit guarantee scheme will be very minimal, and this will support growth.
Okay. Yeah, I guess an interest subvention and, as you say, credit guarantee could be perhaps actually welcomed because rural consumption is something even urban India wants, which India Inc. also wants. Hiren, on that point, really, there are people who have been suggesting, forever that the income tax thresholds need to be increased. After all, we have gone through a bout of 6 and 7% inflation. So keeping the direct tax, income tax thresholds unchanged for so many years would be unfair. Do you think that will be market positive? Because that will mean more consumption. If the income tax brackets is increased or even that, exemption-free income tax level is increased. Do you think these are big positives for the market?
So I think, Lata, there is a case for reducing the burden on the relatively lower income or the middle income families, because clearly we see the stress when FMCG companies talk about it. The consumption at the bottom end is struggling for a while.
Yes.
Because of 2 years of COVID lockdowns, higher healthcare costs and inflation, everything put together, right? So I think some relief there is welcome. But I think that what Nilesh mentioned, right? I mean, rather than reducing your tax revenues, if you can use the balance sheet of the government to guarantee credit to the bottom of the pyramid, then you can achieve the same stimulus to consumption without actually either sacrificing revenue or spending too much, right?
Okay.
So there are smarter ways of doing that, but I completely agree. I think, in fact, I do believe and I hope that there is some amount of capex which is directed towards rural infrastructure, rural housing, water, schemes and so on and so forth, so that if there is spending there, then there is a reason for people to earn higher incomes and consumption will bounce back.
Yeah, I agree with you that, we are still a little muddled about the health of the consumption at the bottom of the pyramid. I mean, Asian Paints and D-Mart had me worried, but Hindustan Unilever, Havells and Polycab are indicating that looks like consumption is, not all that bad. But I guess the government will have to figure out some way of keeping consumption as well encouraged. I think that, as you both point out, could be market positive. Okay, a last final sentence from both of you. Nilesh, what would be your idea of an outstanding budget? What do you want to hear?
A finance minister betting like Surya Kumar Yadav, bowling like Umran Malik, and fielding like Ravindra Jadeja, which is increase infrastructure allocation, give fiscal prudence, and raise non-tax resources.
I mean, this guy is a market veteran. He's a tax expert like, say, a Ranina, and he's a Harsha Bogle as well. Okay, Hiren, what would your idea be of what you want to see as a brilliant budget and what you definitely don't want to see?
Well, he set a very high standards. So I'm going to just do some plain speaking. But no, I think, definitely focus on capex. Second would be something in the budget. I'm using an old term like investment allowance reserve or accelerated depreciation. Something that will really get the animal spirits of private capex up and running. Because there is only that much that you can do from the government balance sheet, right? So we have to use other incentives to get capex accelerated. Okay. And finally, no tinkering with cap gains rates. In fact, a dream thing would be to roll back the 10% capital gains that we have on long term. Okay. And just have a simple short-term capital gains tax and an STT. That's it.
Okay, fair enough. Any sector you would go long on, Hiren, before the budget?
You know what? We are long on India. We are long on the markets. I don't want to be too selective at this point in time. I'm fairly confident that we should have a very progressive, development-oriented budget.
Fair point. Nilesh?
I'll be echoing what Hiren Bhai said, but infrastructure sector looks to be a sector to go long in anticipation of a budget which will enhance allocation to infrastructure.
With that, it's a wrap on this special broadcast on what the market wants from the budget. More news and updates follow. Stay tuned.